Okay, Juliet, Jepto, and Edna.
Present.
Susan?
Present.
Okay. So today we are going to look about I'm going to take you on bank reconciliation statements. Today is 24th. I'm going to look at the line outcomes. So in the line outcomes, let's first write the bank reconciliation. In the learning outcomes, we are going to look at the definition. The purpose. And items that cause the difference in balances between the cash book, balance, items that imbalances. And then we are going to look at the format. If we will have time, or when time will be on our side, we will look at the format. Then illustration, if possible. So, who can define for us the term bound reconciliation statement? In groups of two or okay, Frederick.
Okay, let me try. Bank reconciliation is a process of comparing the cash book balance with the bank statement balance to identify and correct any difference between the two records.
Okay, that's correct. Another try for another version of the definition. Edna?
It's a process that matches the cash balance in a company's accounting records to the corresponding bank statement balance.
Yeah. All of them are correct. So it just depends on your understanding, on what you are comfortable with. So to make, in summary, bank reconciliation statement is a statement that tries to explain the differences between the bank statement balances and the cash book balances. So the next thing we are going to look at the purposes of the bank reconciliation statement. Why do we need to reconcile our balances? Edna?
To ensure accuracy.
Okay, to ensure accuracy.
To detect fraud or unauthorized transactions.
Yeah, to detect fraud.
To provide up-to-date information.
To provide up-to-date information. Prudence is circulating your hand.
Provide a clear picture of cash position.
Okay, to provide a clear picture of cash position. So, are we okay with that?
Yes.
Process and information. So the next thing we are going to look at the causes. Items that cause the differences between the bank balances and the cash book balances. We usually have timely differences. We have timely differences. Frederick, we have timely differences
And errors.
and errors. Yeah, timely differences and errors. Timely differences and errors. Who can Yeah, these are the checks that have been deposited directly to the bank. But the company are not aware of. Okay, President?
Okay, and presented checks are checks that have been given to suppliers, but they have not presented to bank for the bank to credit our account.
We have unpresented checks and uncredited checks. There are no timing differences. Who can tell us about uncredited checks? ChatGPT is there. Please confirm. Cheryl?
Those are checks not cleared by the bank. Okay, they are not already cleared. Okay, so they allow us to process. So we receive by the bank but not cleared. That's according to the real estate.
Okay, uncredited checks. Check deposited but not yet credited by the bank. Yeah, you're correct. What else? What else is any difference?
Direct deposits.
Number 3 is direct deposit. It's bank loan.
You may find customers or other parties may deposit money directly into the business account. It may have in the bank statement, but not yet in the cash.
Yeah. Similar.
Yes.
What else? Bank charges. Bank charges, then interest. Dividends. Okay. Timely difference, we have finished on timely difference, so we are going on errors. But we have A and B. Errors. We have errors in the cash book and errors in the bank statements. What about errors in the cash book? A business can make some errors. Some of them will be maybe overstatement or overstated or understated.
Yes.
Errors while posting or transacting. Or in bank statement, they can also do the same. They can post charges, they can overcharge or undercharge. Then we have finished on the items that causes. So we are going to look at the format. Are we all going with that?
Yes.
So, in the format, we shall start with the business name. Let's say, for example, Afro Badasi. Afro Badasi. That's a business name. And then we start with a statement. A statement will be bank reconciliation statement as at, let's say they did their reconciliation on 31st March. It's usually a period of 1 month or weeks, or it depends on where they have identified the error. Let's say 20, 35, 35. Here we usually have particulars and amount. Then amount. In particular, we usually have the balance of the cash book. The balance as per cash book. No, I have a big handwriting, so that's a very cash book. We are going to look at one format because of time. So here we'll put the amount. Then you add and present the checks. You'll also less and credited. And credited checks. Remember, if when we less, we put into bracket to indicate that we are subtracting. And then the answer that you will get here will be called balance as per cash, as per bank statement. Are we together?
Yes.
So that's a simple formula of bank reconciliation statement. That's a very simple formula that you can use. But you have to form it in a format. That's one of them, which is usually used most of the time. And that is the end of our topic. And I would just like you to tell me what you have learned today in this topic. What you have.
So, bank reconciliation statement.
That's nice. Martha?
This is a difference in
Okay, that's fine. Points? Juliet? The format of bank reconciliation. Okay, thank you very much. That marks at the end of our lesson today. We'll meet on the next time, and I would like you to look for the illustration as my assignment. And its due date is from the next lesson. So I will be checking before I start the lesson.